I'm Dr.V.Subhamathi, working as an Associate Professor, Department of Management Studies, Bharat Institute of Higher Education and Research. Course code P20Mbmc028. Subject name Financial Management. In this session, we are going to discuss about capital structure. Capital structure is a very important for every organization and company because capital structure is nothing but is just a mixture of debt and equity. So if any company is going to start without debt or without equity, they cannot start a business. That means without capital there is no any business. So in this capital structure, what we are going to look at, what we are going to see in this means capital structures, debt plus equity. How much debt is better than for organization? How much equity is better for the organization? That is what we are going to discuss very elaborately in this session. So first definition. Capital structure of a company refers to the composition of its capitalization, and it includes all long-term capital resources like loans, reserves, shares and bonds. So this is the capital structure. So this is the way we can able to mix up our capital. So either we should go to the loans or reserves or shares and bonds. So loans is just a debt and shares are completely equity. So that is the long-term capital sources are the loans, reserves, shares and bonds. And another definition given by Scavetti. The capital structure of a business can be measured by the ratio of various kinds of permanent loans and equity capital to total capital. So in the capital, how much loan is there and how much capital is there? So what are the various kinds of that? What is the ratio for that? So how much I need to get? Either 50% or 60:40 or 40:60? How much we should get? So that is the capital structure of a business can be measured by the ratio of various kinds of permanent loans and equity capital to total capital. So that is capital structure. Capitalization versus capital structure. Capitalization, the total amount of securities issued by a company. That is capitalization. Capital structure, the kinds of securities and the proportionate amounts that make up capitalization. For raising long-term finances, a company can issue three types of securities. That is equity shares, preference shares and debentures. A decision about proportionate among these types of securities refers to the capital structure of an enterprise. So these three things, right? So equity shares, preference shares and debentures and another kind of loans. So what is the proportion of these shares, these securities and loans? So that is called as the capital structure. Features of capital structure. What is the things? First one, profitability, flexibility, conservation, solvency, control. Profitability. It should be minimize the cost of financing and maximizing the equity earning per equity shares, that is EPS. Profitability. So definitely in every capital structure they are expecting that they should minimize the cost of financing and they should maximize the earning per share. So that is the profitability. Second one, flexibility. The capital structure should be such that company can raise funds whenever needed. That flexibility is required for all the capital structures. So that is here the capital structure should be whenever we require the money, that capital should be converting into cash very easily. So that is the flexibility is required. And conservation. The debt content should not exceed the maximum which the company can bear. So only that amount only we should get. Yes, n number of loans are we can able to get, but if we are getting so many loans from the banks or some other persons or X or Y means here, so if it is going very exceeded manner, we cannot able to repay that money. So that conservation is very important. The debt content should not exceed the maximum which the company can bear. Solvency. The capital should be such that the firms does not run the risk of becoming insolvent. So that capital structure is, they should be take it into very careful. That is very important. Firm does not run the risk of becoming insolvent. That solvency position should be maintained in the organization. Control. There should be minimum risk of loss or dilution of control of the company. So it should be a very controlled one. So minimum risk of loss will be there and dilution of control of the company should be required. Factors influencing capital structure planning. Internal factors. First one, financial leverage, risk, growth and stability, retaining control, cost of capital. So financial leverage, the use of long-term fixed interest bearing debt and preference share capital along with equity share capital. So this is the fixed interest bearing debt and preference share capital along with equity share capital, the use of, right? So that is called as financial leverage. Risk, definitely in every capital structures we are having some risk. In the debt means we need to pay interest very regularly. If it is equity shareholders means we need to pay dividends to them and we should maintain the good reputation of the company. So definitely everywhere risk will be there. So that risk also we should ascertain. Growth and stability. It influences the capital structure of the firm. So definitely that growth will indicating as how much capital structure is there. And retaining control. It should encourage the issue of additional equity shares. Cost of control refers to the minimum returns expected by its suppliers. Next one is debt. Debt is a cheaper source of finance compared to the preference and equity capital. Due to low risk, that is fixed rate of interest, the legal obligations to pay interest, repayment of debt, and priority in the company if it is winding up. That is very important. So in the stage of winding up of a company, so that company holder should give preference to the debt debenture holders. So that is called as the debts here. Preference capital is also a cheaper than equity due to lesser risk involved and a fixed rate of dividend payable to preference shareholders. So here some fixed rate of dividends will be there for the preference shareholders. Definitely, if it is companies going in a loss or if it is companies not able to pay the dividends, means in that situation also preference shareholders will get the benefit. Equity shareholders will get the maximum risk and maximum profit and maximum loss they will get. But preference shareholders somehow they are getting the fixed rate of dividends. Equity capital. Equity capital is more expensive sources of finance due to high risk. That is, rate of dividend is not fixed for them. No legal obligations to pay dividend and payment at the winding up of the company, and that too after paying all other obligations. Yes, so first preference we should give the debts. That means those who are given the loans to our organizations, we need to give the first preference. We need to give to them if our company is in a insolvent position. And next stage is the preference shareholders. Preference shareholders anyhow they are getting the fixed rate of dividends. It should be a fixed one. They will get the some lesser risk than equity shareholders. But equity shareholders, they are in the very high risk. They don't have any fixed rate of dividends and there is no any legal obligations to pay the dividends regularly at the time of winding up of the company too. So that is the equity capital. Cash flows. Firm which shall be able to generate the larger and stable cash inflows can employ more debt in its capital structure. So firm which shall be able to generate larger and stable cash inflows for the organization. If it is more debt means that is a very big good thing. And flexibility. The firm's ability to adapt its capital structure to the needs of changing condition. That is flexibility. Purpose of finance. It is required for the productive purpose. Yes, I am getting money, but no use of to get the money for the company means that is not giving a good success. So here the purpose of finance is very important. So for what purpose you are getting that money from the public or bank? So that is the purpose of money. We should use it very productive manner. And asset structure. Funds are needed to make investment on fixed assets and current assets. So how much money that company is going to invest into the fixed assets or invest into the current assets? That is a very important one under the asset structure. External factors. Size of the company. If the size of company is small, the requirement of finance is too little, and if it is big, it required a large amount of capital. So whatever the size of business is small, the requirement of finance is too little, and if it is big, it required the large amount of capital. So whatever the business, definitely we require the some capital for the organization. Nature of industries, method of production and type of product, that includes the nature of industry. That is, we have to understand in some organization, in some companies, they should not have that much of production liability. If it is service oriented organizations, mean they will not seek that much capital, because they don't want to buy any machineries, land, equipments and all. So that is based upon the industries that capital requirement will be more. Investors, in every organizations, definitely they will have some investors for them. They should pay the dividends regularly to them. Cost of flotation. So it refers to the expenses a firm incurred during the process of public issue, that is advertising, campaigning, printing of application forms, fees of merchant bankers, underwriting, commission, brokerages, etc. Legal requirements. Legal and statutory requirements of the company will also influence the capital structure. So here the SEBI guidelines on investors' protection, maintaining DE ratio and current ratio for them. So that is the external factors. And some more external factors. Period of finance. Funds are required for different period of different purposes. Short term 1 to 3 years, medium 3 to 5 years, and long term 8 to 10 years. Level of interest rate. Rate of interest will have a direct impact on borrowed funds. Level of business activity. It required more funds for expansion and diversification based on the expansion diversification. That is very important. Availability of funds. It directly influenced the company at the time of issuing security. Taxation policy. High corporate tax, high tax on dividend and capital gains directly influence the decision of the capital structure. Level of stock prices. Firm has to invest such funds either through equity or preference capital based on level of stock price. Reasons for changes in the capital structure. Why we are changing that ratio? So maybe 70 is to 30, maybe 30 is to 70, 60 is to 40. Why that changes are there? So first one, to restore the balance in the financial plan, to simplify the capital structure, to suit investors' needs, to fund current liabilities, to write off the deficit, to capitalize the retaining earnings, to clear default on fixed cost securities, to facilitate mergers and expansion, to meet legal requirements. So these are the reasons for changing the capital structure. Capital structure theories, very important one. Capital structure theories. The general assumptions of capital structure theories. There are only two sources of funds, that is debt and equity, no preference share capital. The total assets of a firm and its capital employed are fixed. No change in capital employed. However, debt equity mix can be changed. either by borrowing debt to repurchase equity shares or by raising equity capital to repay the debt. All earnings are distributed to earnings distributed to equity shareholders to retain the earnings. The firm earns operating profits and it's expected to grow, no losses. The business's risk is assumed to be constant and is not affected by the financing mix decision to change in fixed cost or operating risk. There are no corporate and personal taxes, no taxation. The investors have the same subjective probability distribution of expected earnings, no difference in investors' expectations. Capital structure theories. There are four major theories or approaches explaining the relationship between capital structure, cost of capital, and value of the firm. These theories can be broadly classified into two categories. First one, theories which suggest the capital structure affects weighted average cost of capital. First one, net income approach. Second one, traditional approach. The theories which suggest the capital structure does not affect the WACC. Net operating income approach, Modi-Gilani-Miller approach. Net income approach. This approach has been suggested by Durand. Change in the capital structure causes a corresponding change in the overall cost of capital as well as the total value of the firm. This approach states the higher debt content in the capital structure, that is high financial leverage, will result in declining in the overall or weighted average cost of capital. It causes increase in the value of the firm and consequently increases in the value of the equity shares of the company. Assumptions: there are no corporate tax, the cost of debt is less than cost of equity or equity capitalization rate. The debt content does not change the risk perception of the investors. Formula: V equal to S plus B. So where V equal to value of the firm, S equal to market value of equity, B equal to market value of debt. Market value of equity can be ascertained as follows. So S equal to market value of equity, NI earnings available from equity shareholders, and KE means equity capitalization rate. So this is the relationship between the leverage and cost of capital. So leverage and cost of capital. So here debt minus equity mix. So based upon this we have to inculcate the leverages and cost. If it is good means we can take it for the organization. From the above graph it was found that WACC KO decreases as the KD is less than the KE, which increases in the value of the firm. KD as the debt proportion is increased. KP will never touch the KD as there cannot be 100% debt firm. If the firm is 100% equity firm, then the K0 is equal to KE. The rate of decline into KO depends upon the relative position of the KD and KE. Increase in value. The value of the firm according to NI approach will get increased in case the amount of equity is decreased by issue of debenture, bonds, etc. to equity shareholders. Decrease in value. Similarly, the value of the firm according to NI approach will get decreased in case the amount of debt is decreased by issuing the additional equity shares. Traditional approach. It is also known as intermediate approach. The value of the firm can be increased initially or the cost of capital can be decreased by using more debt as the debt is cheaper source of funds than equity. The cost of equity increased because increased debts increased the financial risk of the equity shareholders. Assumptions: the cost of debt KD is always less than the cost of equity. KD and KE vary with the change in the debt equity mix. As debt content increases, the financial risk increases, causing increases in the expectation of equity investors and rise in the cost of equity. Increases in cost of equity is steeper and higher than increase in cost of debt. So this is a small graph about the debt equity mix, cost of capital in terms of percentage, phase 1, phase 2, phase 3. So KD, KE and KO. Net operating income approach. This approach has also been suggested by Durant. The market value of the firm is not at all affected by the capital structure changes. The market value of equity is ascertained by deducting the market value of the debt firm or the market value of the firm. Assumptions. The overall cost of capital remains constant for all degrees of debt equity mix or leverage. The market capitalizes the value of the firm as a whole and therefore the split between the debt and equity is not relevant. The use of debt having low cost increases the risk of equity shareholders. This results in increasing in equity capitalization rate. Thus, the advantage of debt is set off exactly by increase in the equity capitalization. So this is the formula. So V equal to EBIT divided by KO. So value of the firm, overall cost of capital, EBIT means earning before interest and tax. So value of equity is the residential value which is determined by deducting the total value of the debt from the total value of the firm. Thus, the value of equity can be determined by the following equation. So S equal to V minus B. So value of equity equal to value of firm minus value of debt. So another one is EBIT minus I divided by V minus B. So this is the formula. So again one small graph relating to the debt equity mix are related to the net income approach. So KD and KO are constant for all levels of leverages. As the debt proportion or the financial leverages increases, the risk of the shareholders also increases and thus the cost of equity capital KE also increases. The increases in KE, the overall value of the firm remains same. As the debt proportion is increased, the KE also increases. However, the overall cost of capital remains constant because increases in KE is just sufficient to set off the benefits of cheaper debt financing. approach, so Modi-Gillani-Miller approach. It is developed by Franco Modi-Gillani and Merlin H. Miller. It affects the understanding of effects of gearing. This is the identical with the net operating income approach if taxes are ignored. Assumptions. The capital market is assumed to be perfect. The existence of perfect capital market implies that both individuals and investors can borrow unlimited amounts at the same rate of interest. There are no limits of borrowing. The investors are free to buy and sell securities and are well informed about the risk and return involved in different securities. All securities are infinitely divisible. There are no transaction costs. There are no brokerages or other transactional charges. The debt is less expensive than equity. Increase in debt level will cause to increase the cost of debt. The increased debt will increase the financial risk of firm and expectations of the equity holders will be more. Thus, the average cost of capital will remain constant for all level of leverages. There is no benefit to debt financing other than reduction in corporate income taxes due to tax shield of interest payment of debt. Interest rates are equal between borrowing and lending firms and individuals. The capital markets are efficient. The information is scarce, less than and readily available to all investors. There are no personal taxes and corporate income taxes. All investors are only price takers. No individual can influence the market price of security by the scale of transactions. The firm investors' schedule and cash flows are assumed to be constant and perpetual. Theory, there is no tax action. Increase in debt will increase the debt required rate of return on equity. Average cost of capital is constant for all levels of leverage as shown in graph. So this is the graph cost of equity, average cost of capital and cost of debt. Value of firm will increase and cost of capital will decline. with leverage with introduction of taxes. VL equal to VU plus DT. Value of levered form, value of unlevered form, D equal to debt and T equal to tax. So value of levered form is more and overall cost of capital will fail. Firm should use debt up to a point. Division of hypothesis. So this is a small formula. So EBIT 1 minus T divided by KO. So EBIT earning before interest and tax and KO means overall cost of capital. So next important one is the dividend decision. So definition, a dividend is a distribution to shareholders out of profits or reserves available for this purpose. So it is the part of the net profits of the company which is distributed among its shareholders after execution of retaining earnings. Sources of dividends, earnings from regular operations and accumulated from previous years, income from subsidiaries, profit from sale of appreciated property, conversion of redundant reserves, surplus from mergers and purchase of subsidiaries, revaluation of assets, donated surplus, and surplus earned by reduction in capital stock. Forms of dividends. So dividends paid in the ordinary course of business are known as profit dividends. Dividends paid out of capital are known as liquidation dividends. On the basis of types of shares, equity dividend. Dividend paid on equity shares called as equity dividend. Preference dividend. Preference dividend is the dividend paid to preference shareholders on the basis of mode of payment. Cash dividend, so in the form of cash, dividend is issuing to the shareholders. Bonus shares and stock shares. So stock dividends means issue of the bonus shares to the existing shareholders. Scrip or bond dividends. A scrip dividend promise to pay the shareholders at some specific time. Property dividend. Property dividend are paid in the form of some asset other than cash. Composite dividend. When dividend is paid partly in the form of cash and partly in other form, it is called as composite dividend. On the basis of time of payment. Interim dividend. The dividend paid between two annual general meetings. Regular dividend. Dividend declared in the annual general meeting is called as regular dividend. Every year company declares the dividend in its annual general meeting. Special dividend. A sound dividend policy should be formed in such a way that rate of dividend should not be changed frequently year to year. The rate of dividend should be static. Dividend policy. Dividend policy determines the division of earnings between the payment to the shareholders and retained earnings. It refers to the policy concern, quantum of profit to be distributed as dividend. Nature of dividend policy. Tie-up with retained earnings constitute important area of decision making and problem solving for the financial manager. Impact on shares. Forms of dividend policy. Same way, regular dividend policy, stable dividend policy, irregular dividend policy, no dividend policy. Dimensions of dividend policy. So payout ratio under that, funds requirements, liquidity, access to external sources of financing, shareholders' preferences, differences in the cost of external equity and retained earnings, and control. Stability of dividends. So stable dividend payout ratio, constant dividend per share, stable dividend or steadily changing dividends, and some limitations are there. It cannot be changed without seriously affecting investors' attitude and financial standing of the company. Effect on investors more severe than failure to pay by a company and unstable dividend policy. So factors affecting the dividend policy. So stability of earnings. Formulate a more consistent dividend policy than a firm with fluctuating earnings because a firm is better able to predict what its future earnings. Financing policy of the company. The internal financing policy of the company influences the dividend policies of the business firm. Liquidity of funds. The payment of dividend result in cash outflow from the firm. If the firm good liquidity position, it is advisable to pay dividend to the shareholders and vice versa. Dividend policy of competitive concern. Past dividend rates. The dividend rate may be decided on the basis of dividends declared by the previous years. Debt obligations definitely will be there. Ability to borrow. So company requires finance both the expansion program as well as for the meeting of unanticipated expenses. Hence the company have to borrow from the market. Growth needs of the company. It needs more money for growth and development. Profit rate. Internal profitability rate of the firm provides a basis of comparing the productivity of retained earnings to the alternative returns which could be earned elsewhere. Legal requirements as per Indian Companies Act, policy of control and corporate taxation policy. Aspects of dividend policy. So some of the legal aspects are there. So companies can pay only cash dividends. Dividends can be paid only out of profit earning earned during the financial year after providing for depreciation and after transferring to reserves such percentage of the profits as prescribed by law. So specific dividends like where the dividend proposed exceeds 10% but not 12.5%, the amount to be transferred to the reserve shall not less than 2.5% of the current profit. Where the dividend proposed exceeds 12.5% but not 15%, the amount to be transferred to reserves shall not less than 5% of the current profit. Where the dividend proposed exceeds 15% but not 20%, the amount to be transferred to reserves shall not be less than 7.5% of the current profit. Where the dividend proposed exceeds 20%, the amount total reserves shall not less than the 10%. A newly incorporated company is prohibited from transferring more than 10% of its profits to reserves. Due to inadequacy or absence of profit in any area, dividend may be paid out of the accumulated profits of the previous years. So some of the conditions also there. The rate of dividend declared shall not exceed the average of the rate at which dividend was declared by it in 5 years immediately. The total amount to be drawn from the accumulated profits earned in the previous years and transferred to the reserves shall not exceed and an amount equal to 1/10 of sum of its paid capital. The balance of reserves after such withdrawal shall not fall below 15% of its paid up capital. Dividends cannot be declared for past 5 years, which amount have been closed. So procedural aspects. So board resolution, shareholders, record date, dividend payment and paid dividend. So dividend theories, this is important one. Irrelevance of dividend. So Professor Solomon has framed the Modi-Gilani-Miller approach to prove the irrelevance dividend concept. So shortly we are calling it as approach. The dividend policy of the company is irrelevant under certain conditions like perfect market, rational investors, absence of tax discrimination between the dividend income and capital appreciation. Given the firm's investment policy, its dividend policy may have no influence on the capital price of shares. Assumptions: perfect capital market, investors are rational, there are no tax. So this is a small proof. So P0 equal to D1 plus P1 divided by 1 plus KE. So prevailing market price of a share, cost of equity capital, dividend to be received at the end of period, market price of the share at the end of period 1. So this is the proof for irrelevance theory of the dividend. Relevance theory, so Walter's model. So Professor James E. Walter argues that dividend policy almost always affects the value of the firm. So rate of return, cost of capital, if R greater than K means the firm is able to earn more than what shareholders could by reinvesting if the earnings are paid to them. If the firm has R equal to K, it is a matter of indifferent whether earnings are retained or distributed. So some of the assumptions: the firm uses only internal finances, the firm does not use debt or equity finances, the firm has constant return and cost of capital, 100% payout. So this is the formula: P equal to D plus R divided by KE into E minus D divided by KT. So market price of an equity share, dividend per share, internal rate of return, earning per share, cost of equity capital. Gordon's model. So assumption: the firm is an all equity firm and has no external factors. Finances: cost of capital and return on constant. The firm has perpetual life and there are no taxes. So this is the formula: P equal to E into 1 minus B divided by KE minus BR. So price of share, earning per share, dividend payout ratio, capitalization rate, growth rate. Share splits. So definition for share split is a method to increase the number of outstanding shares through a proportional reduction in the par value of the share. It affects only the par value and number of outstanding shares. The capitalization of the company is not changed at all. Reasons: provide the broader and more stable market of the stock, increase the marketability of new issues, the firm generates funds by use of share split. Mergers or acquisition of companies through exchanges of stocks will often split its stocks to make the transaction more attractive. Share split will add to the marketability of shares of the shareholders. So bonus issue, share split. So bonus shares means additional free shares allotted to the existing shareholder. Share split, it is a process of dividing the face value of shares. Face value of share is not changing, face value is changing. Share capital, the number of shares are increased. Share capital is not changed by the number of shares is changed. Only a certain amount of the reserves is used. The reserves is not capitalized. Once again, I want to thank Bharat Institute of Higher Education and Research. Thank you.